It's kind of like trying to finish the assembly of the airplane at the 30,000 feet level.
Yeah, oh, it is. And it's hard to redo that because it disrupts the business. That's why it's so key to set these things up front.
Welcome to Beacon for Business, the podcast that illuminates the path to clear, structured financial systems for established CEOs, entrepreneurs, and startups. I'm Brett Spencer, owner of Spencer Business Advisory. I help companies strengthen their financial health and streamline operations. Today, I'm speaking with Michael Breshears, or Mike to me. Mike and I have known each other for nearly 30 years, where we worked together in multiple companies. Mike attended University of Utah and University of Phoenix in business. He's been involved in multiple industries and executive roles, starting in retail, large grocery chains, and convenience store chains, and then currently in the network marketing industry. His most recent work was as the CEO of an international networking direct sales company. He took the company from a startup to an international organization with offices in over 25 countries and achieving over $350 million in annual sales. Thanks for joining me today, Mike.
Brett, it's nice to be with you. I've enjoyed doing this. I laugh when you call me Mike, because it sort of depends on how long I've known people. People that I've known long, like you, and worked with for a long time, call me Mike, and those in the last 10 or 12 years, I'll call me Michael. So I can always gauge that. It's not that I changed my name, Brett. It's just the way that it worked out. So
the last company we worked together on, which was an international startup company. The people in the organization that I would talk to would always say Michael. And I thought, who's Michael?
It's nice to be with you today. So I appreciate being able to work with you on this podcast.
Well, I really appreciate you joining us. One of the things that I learned quite well with working with you, in fact, just a year ago, we were working on an international startup, and you are a stickler for the financials, and you wanted them to look in a certain way. And you were very specific and particular how those appeared. Why is that so important to you, Mike?
Well, I believe that the financials and the statements and the subledgers are key to operating the business. And I know that a lot of people think, well, it's not that really important. The financials are primarily a legal requirement and for taxes and so forth. But that's not accurate. And in truth, the financials can be a huge source of information that can help you manage and run the business. In fact, if they're not, then they're not been set up right and set correctly. So it is a key tool for running the business and evaluating the business as you go along.
So let's talk about kind of the start of the company. You've been involved in a lot of startups. You've come in with companies that have started, but then you took them much further than where they were before that you got there. What are some of the things that founders need to be aware of when they're thinking about starting a company?
Well, I mean, there's a lot of things, and it's sort of, I'm not going to try to share on that, but I mean, you got to have things like products and the operating philosophy. They're going to manufacture their products. And again, it depends on the industry. Okay. But my recent, last 20 or 25 years, these are some of the things that we dealt with. If we were going to manufacture, we're going to do contract manufacturing or a combination of those. And then operating areas. Are we going to expand internationally? Or are we going to be primarily domestic? Those are things that have to be thought about up front, because they, in truth, define and drive how you're going to set up the financials in these, what I keep calling subledgers. And of course, and there's a lot of other issues that founders of a company are going to intuitively understand about what they want to do and what their goals are. But then, of course, the last thing is funding. And the funding, I mean, you got to have funding, and that sounds almost trivial to say it, but it's true. And you have to have planned for funding to fund the sufficient expansion that you plan to do. And I've seen a lot of companies that haven't planned for that, and they have success, and then they've got questions of how to fund that continued growth. But those are some basic things, and those basic things drive how you're going to set up these financials and these subledgers.
Absolutely. And I think we've both seen instances where companies were growing and maybe they were going to launch a different division or they're going to launch a different product line. And the growth actually just about did them in because they weren't prepared for the extra expense and the cash flow demands.
Right. Exactly. And we'll talk about that as we get into some of the detail here. But if you don't set some of these things up properly to start with, it is a huge problem later on. I mean, you're going back and trying to revamp these ledgers, these financial statements, the capture of information and the reporting of this information, and it becomes a much bigger and, in fact, more disruptive process at that point. So it is important to at least have a good foundation as we get started.
Yes, I've had a little bit of experience coming into companies. It's kind of where I've made my living the last 30 years is coming into companies.
I know.
And trying to get the financial foundation established. And sometimes it's kind of like trying to finish the assembly of the airplane at the 30,000 feet level.
Yeah. Oh, it is. And it's hard to redo that because it disrupts the business. That's why it's so key to set these things up front.
The other thing you talk about a lot is how you set up the financial statements and the structure and how you use that as an executive, how you use the financials as an executive to make decisions on anything within the company, whether it's minor day-to-day issues or strategic planning, growth, general direction of the company.
Yeah, and I think we can get into some of those things that sort of I'm thinking about that as to how we do that. But it's right; it's key to define that. And it sounds like chart of accounts. I mean, gee whiz, how much more boring can we get than talking about a chart of accounts? All right, and I'm not a financial guy. Obviously, you deal with the financials, but I'm not the financial person like you are. But I have learned and understand that defining that chart of accounts up front is key to being able to have the information available to run the business as you get going. And you have to get a balance between the amount of detail that you have and you report in the financials versus how much you put into the subledgers. You have to think about that because you can't report too much detail in your financials, but you have to have a sufficient level that you can see things that will enable you to say, hey, I've got to check this out. We got to go down a lower level. We've got to look at that. You have to do that. And some of the things up front that you have to define is you got to define what kind of departmental breakdowns do you want to do. I mean, do you want to break out marketing? Do you want to break out IT? Those kind of things you need to think about up front. And of course, they all flow into a consolidated, of course, but you got to think about that up front, or you're trying to adjust your financials later on, as you start to have a little bit of growth in the organization. And that's, as I said before, that's not a good place to be. And then the other part we talked about earlier is international. Do you want to go international or not? And if you do, you have to be thinking about that because that impacts your financials and sure in the detail of your financials.
And obviously with international, you're dealing with different currencies. And
yes.
So you have to keep that in mind when you're setting things up and have a pathway to bring everything back into your currency. In our case, it was US dollars. And so you have to make those conversions.
Yes. Oh, yeah. The currency conversions and those kind of things, are going to be huge issues. And the way you set these financials up, that's going to, if you're talking international and you have international offices, and sometimes you may have international business, but not an international office. So all those things will vary. But if you have an international office, these financials are going to drive how you're also reporting. Even if you have local reporting requirements from the government, it's still going to drive the level of detail that you're going to capture and report.
Plus,
because they have to flow back smoothly.
I'm a big proponent for budgeting and forecasting, and to be able to do that, you've got to, and if you want to, like you say, have financials by department and they need to be meaningful, and the department breakouts need to be meaningful so that department heads, whether they're vice president level or management, they need to see how they're doing in their piece of the company. And so it's important to have that that detail. I'm not a proponent of having an account for every expense, but definitely they need to make sense, and it needs to be set up in a way that you can manage your business and drive profitability and drive growth, the things that are important to you.
Of course, and you've got to be able to have a certain level of detail there. So when you go to do the budgeting, you can look at historical things and come back and as you plan for the future. Because if it's too gross, if it's too high a level, you're never going to be able to draw out the information you need to run the business or to do your budgeting and forecasting.
So you set it up, and then you basically need to be able to run reports on a monthly basis, quarterly basis, annual basis, and share the applicable information to the management team so that they know how they're doing and what they need to do, maybe make some changes.
Exactly.
So it all starts with sales.
Yeah. So maybe we go through and talk about some of these various breakdowns, and just talk about not all of the aspects of the financials and everything that's in there, but some of the key areas and where you'd have to have a little bit of focus. And as you said, you start with sales. I mean, sounds obvious, but it's the top line. And you better think a little bit about your sales and how you want to capture that detail. If you've got multiple products, I mean, we said at the beginning, you got to define your products and so forth, and whether they're manufactured, contract manufacturing, so forth. But are you going to capture those sales by product, or is it not necessary? Okay, I don't know. It depends on the industry and what you're doing. But you've got to look at that and your different types of sales. Want to break out returns? You got to be able to see that as a line item on your financials, because you've got to be able to evaluate that. I mean, returns can be a huge issue for you. So sales is not just one big number. You've got to think about how to break that out and by product.
And the returns are really important, because you need to, if you're getting a lot of returns, and you need to understand why. Is it product, faulty product, or is it we shipped the wrong product to them, so we made a mistake in the shipping process, those types of things, so that you can correct any misdirection.
Right. And so exactly. And we're talking about, I know we're talking about in the financial aspect of this, but that itself becomes operational issues on how do you, when you get returns coming back in, and almost every business is going to have returns to a greater or lesser degree. How do you process those through your controls and capture what's reusable, how do you get it reported in the financials and that type of thing? So that's another process. We're not going to cover that now, but that's another operational aspect that you better plan and handle up front. Or you end up with a bunch of stuff sitting in a warehouse or in a back room or something. You don't know what's there. You don't know anything about it. And you have to be able to understand that.
And there are times when it's more economically feasible to tell the customer to keep it or throw it away rather than to take the expense to ship it back.
Again, you're right, and that depends on the business that you're in and the products you're shipping and that type of thing. Absolutely.
So another really key area is cost of goods, and I can't tell you how many companies I've gone into, and some of them were mature, bigger, larger companies that didn't really know what their costs were. They didn't know their full absorbed costs of what they were selling. And that really created challenges, because when you do specials and you do promotions and discounts, what is your margin to begin with? Which, if you don't know your costs, you can't tell what your margin is, which is cost less. Cost of goods sold is your gross margin. And so,
absolutely, yeah,
can't say enough how important it is to understand what your cost structure is.
So, cost of goods, I mean, I don't mean this literally, but that's a real passion of mine when it comes to financials, because it is true. So many companies don't have an accurate, realistic picture of the cost of goods. If you don't have a good picture of the cost of goods, you can't set your pricing. You can't get into, which we'll talk more about, but you can't get into transfer pricing. You can't do anything, because you're thinking, here's the margins that I'm making, and here's where it actually is. And I mean, those cause huge problems for companies, and having an accurate picture of the cost of goods. And so there's many things that go into that cost of goods. I mean, if you're doing contract manufacturing, there's different aspects of costs that go into that. You've got different shipping costs. Okay. Shipping from, maybe you're dealing with storing some raw materials, and that becomes part of it. If you're acquiring some raw materials yourself for a contract manufacturer or something like that, the shipping of those, quality testing of those, all of those types of things, and then shipping the product to your distribution point, all of those things
Yes.
have to go in there. And I mean, without those kind of details, which are easy to miss, and as we talk about expenses, they're easy to miss, and they flow down into the expense line, and they get lost down in the expenses, and they're really cost of goods.
Yeah.
And
And
that,
then that affects your margin and your ability to make decisions.
no, it's true. And then as we, that, that a wrong cost of goods, if you have the wrong cost of goods, you're in trouble from the very beginning. And I mean, it's so easy to look at that. If you have a contract manufacturing operation, you look at the price you're paying them and say, well, there it is. That's not true. There's a lot of other expenses that go into that cost of goods.
I think a simplified way to look at it is anything that any cost that you have to incur to bring a product in to be ready to sell should be in cost of goods. And that includes, if you're a manufacturing company or you have your own warehouses, the manufacturing overheads and the warehouse overheads should probably be, well, they shouldn't probably be, they should be included in the cost of goods one way or another. And sometimes what I've done in the past is created a shop labor rate or a warehouse labor rate. And then as the people who are working out there present their time cards, we have so many hours worked in a week or in a 2-week period or a monthly period. And that times that calculated labor rate, which includes the overheads, would be part of that cost of goods sold.
Agreed. And you know, those, some of those types of things, you can break out separately as a subset so that you can see those in there, and then it can roll into the total
Yeah,
cost of goods.
absolutely.
So some of the other things we're talking about are direct cost of goods, but even like we're talking about the distribution and some of that, you can have that as part of the cost of goods, but you'll want to break that out so that you can see those things and then roll it in to a total. But
And the sales company that you and I worked on a year ago, it was basically a virtual company, and we used 3PL service centers that we would purchase the product and have it shipped to those centers, and they would warehouse the products for us, and then in turn ship the products out to the end customer. So in that case, it's fairly easy. You know, your charge from that 3PL includes, everything out other than the cost of purchasing the product, but it includes everything that should be in that process.
right. And and in some cases, you'll have it one warehouse, and that can be a fulfillment warehouse for one area. And that will also be a supplying warehouse for another warehouse in a different location, maybe in Canada or Mexico or whatever, as an example. But then, you have costs that are involved in that, which is going to affect your cost of goods for that location, for that international location. And when you get into these international locations, again, like we mentioned earlier, you've got transfer pricing, and
Yes.
transfer pricing is critically important. And it all starts with the cost of goods.
Yes.
If you don't have accurate cost of goods, you're not going to be able to do accurate transfer pricing, which then will impact your profitability in those international entities. And we like to think that, oh, well, we can set those transfer pricing wherever we want, okay, because we can use that transfer pricing as a mechanism to bring costs back, to bring profitability, I mean, back to corporate. But as much as we like to denigrate government, they're not idiots. And these governments in international countries, they understand what the process, and they can get very strict on the transfer pricing. And you better be able to back up what you're doing. If you don't, you're going to get into some bad audits, of which I know we've been involved in those, and you've been personally
Absolutely.
in those, and that's not
Absolutely.
what.
So I don't want to go into a lot of detail on this, but it's, you mentioned transfer pricing, so I'll explain a little bit what that is. You've got say you have a U.S. company, and that U.S. company has a subsidiary in Mexico and a subsidiary in Canada. The transfer pricing comes in if the U.S. company is supplying those subsidiaries with the products to sell, then the other countries, every country, the U.S. and Canada and Mexico, are interested in getting their fair share of the pie as far as taxable income. And what they are looking for is to make sure that if the tax rate is lower in the U.S. than it is in Canada, or Mexico is lower than the U.S., that you're not parking all your profit in one country, and the other country doesn't get their piece of that action. So transfer pricing is somewhat complicated to do it right. Process where you go through to some steps that IRS has prescribed to determine what the proper transfer price is. In this case, from the United States parent company to the subsidiaries in Canada and Mexico, and you have to go through these steps, and you have to be able to show how you got that transfer price, and then everybody's happy. But like as you said, I've dealt with some audits. They're not fun to do. They take a lot of time, and if you've got your documentation, it makes it a lot easier process.
Exactly. And like we both said before, they understand what's going on. And so the tendency might be to try to pull the profits back to to the entity in the U.S. if you're established as your main base in the U.S. But they understand that, and that's not going to happen. And so, and I mean, again, in the industry that you and I have worked a lot in the network industry and direct sales, is the commission structures. Okay. You have points and things that you do, and we'll talk about the breakout of expenses on commissions on that in a moment. But that again comes back to cost of goods, because you got cost of goods lead to pricing, which will lead to point structures and that type of thing, which will drive your commission structures. And so, but it starts with cost of goods and the accurate.
I'll interject a little bit here. The commissions usually are not part of cost of goods sold.
No. I'm not saying.
In the direct sales industry, it's one of your largest expenses. It's usually larger than, usually some of your larger expenses are salaries and payroll. Commissions in a direct sales company eclipse those things. And it's such a large piece that we would include them in cost of goods sold in that case to help, as part of our margin, so that we knew what we could do with pricing and discounts and specials and things like that.
Yeah.
So
they'd be above that line. They wouldn't be part of the cost of goods per se, but they would be up there so that you could come down to some totals after commissions. But commissions are, but I guess the point that I was trying to make is that it starts with cost of goods. And if you can't accurately capture and define costs of goods, that air flows through your entire business, and it's
absolutely
not pretty.
And whichever industry you're in, you have those types of things. In the direct sales industry, its commissions is a very large piece of it. There's other large pieces, but commissions are, you have to laser focus in on those things that are key to the industry you're in and the company that you're running. And so, and then we'll talk a little bit about the structure here. In a financial P&L, profit and loss statement or income statement, you start off with sales, and then you have cost of goods sold, and then sales minus cost of goods sold equals gross profit and gross margin. And then after that, you have your expenses. And so the expenses could be general and administrative, G&A expenses, selling expenses, marketing expenses. And then you have basically, when you go through that, you have your gross margin minus your gross profit minus your expenses, and then you have net income from operations. So let's talk a little bit about the below the line, the below the gross profit, the the rent, the
Well, before we
utilities.
do that, right, let's back up to the commission area because, and again, depending on the industry that you might be in, that whoever it is we're talking with some focus on direct sales, but commissions are a key area, and you want to again have the proper breakout of the commissions. I mean, there can be startup bonuses, there can be base bonuses, there can be customer bonuses, there can be one-time bonuses, and we're going to talk about subledgers for promotions because all companies want to run promotions, but that is a key area. But that's a subledger. But these are breakdowns that you need to have in your commissions so that when you look at your commissions and obviously the percent of sales, I mean, we haven't talked about that. We will a little bit more, but that's got to be there on all of these line items because that helps set your baseline and understanding some of these standards and and what's an expected percentage of sales for these levels. But then you need to have those breakouts so that you can see, oh, my startup bonuses or my one-time bonuses are getting out of hand. Okay, so you have a point to dip down into your subledgers. The financials are your starting point to understand that. And again, you have to have that breakout, or you have a big commission number, a single commission number, and you say, well, that looks high, and you don't have any place to start. You have to go to the detail at that point, but you need to have a more detailed breakout on your financials
And the ability to drill down to that
yeah
detail.
yes, and then that's going to come into your what I keep referring to as subledgers.
One of the things I like to do, if the financial software that I'm using, which most of them do this now, doesn't do it, I like to look at expenses, costs and expenses as a percentage of revenue. And so,
Yeah,
and no matter what your sales volume is for a given period, some of your overheads are going to vary because they're overheads. You've still got to pay your rent. You've still got to pay the utilities. You've still got to pay your office staff. But there's some key items. Commissions is one of them. The cost of goods sold, in general.
yes,
If you watch that percentage and say your percentage is 40, your percentage of sales of cost of goods sold is like 45%. And 1 month it's 65%. Well, you've got a problem somewhere. Either there's an error in the system or something happened. So,
yeah. And so no, that the percent compared to revenue, or as I always say, percent of sales is a huge deal. And yeah, so then if you'd like, so we can dip down into some of the other expense line items that you want to and talk about the breakout for that.
yeah. So below the gross profit is usually general and administrative expenses. So that's your rent and your utilities and insurances and employee salaries. The the employees that work in production, either manufacturing, often are up above in cost of goods sold, but your office personnel, your overhead personnel would be in this area.
Right. And so as you start to talk about the breakout of labor or payroll, whatever you want to call it, it depends on whether you had these other breakdowns. Okay, what I would call department breakdowns that we talked at the very beginning. If you have those, that may impact what level of detail that you do in labor. But if you don't, or you take a different approach, you want to break out things like maybe IT, and you want to break out marketing, you want to break out sales expenses. And I'm talking just in labor, okay, that we're talking about here, or salaries. You want to know, you don't want to have one line without being able to have contract. You're paying some contract people. That's different than paying internally. You got to be able to see that on your financials. You've got to have those defined as part of the breakout.
Absolutely. And I'll mention it here, and I can't mention it too many times. You have to have your information updated. You can't have a pile of invoices that come from vendors that haven't been entered for 60 days. And
Well,
you
yeah,
laugh,
you
but
mean
I've seen that.
you got to keep those things current. Oh,
Yeah.
that means Yeah, I know we're laughing and joking here, but yeah, so you let them hang out there for 60 days, and that means you don't know what's going on in your business for
Yeah.
60 days.
Yeah.
That's what that means. If you're not capturing all of this on a regular basis, okay, and I don't mean even monthly, you got to be capturing and coding and bringing this information in, and we'll talk about some sub ledgers which are more frequent than the financials. But you've got to be doing it all the time. You have to be continually bringing this stuff in and capturing it, or else you're never going to understand and know what's going on in your business. But then so you get into other breakdowns, you get into travel. And I mean, we can't go through, we could, but we're not going to go through all of the line items in there. But you want to break out travel. And again, all of these are going to be based on whether you did departmental breakouts or not. But it just it's just very key that you have accurate coding and capture as you go into this. And you get into depreciation and other things and office expenses and all these kind of things that are more mundane. But you have to just categorize those and break those out. And you have to think about them up front, or
Yes.
else you've got, and I just keep coming back to that because I've been there. You've got this big total and you say, well, that looks out of line. What is it? And well, we don't know. We dump everything in there. We don't know how to code it. So we dump it all in there.
Yeah.
Not a way to do
And
business.
that goes back to the chart of accounts. You need to have accounts that are
Yep.
meaningful.
That's what I say. So somebody rolls their eyes at a chart of accounts. And so maybe you set it up here at the beginning and you don't have to worry about that so much. But if you don't, you've got more problems coming down the road. Okay. It's just, you're going to have problems.
And the financial review ought to be at least monthly.
Yes.
And
Or whatever the period is, if you're doing periods or if you're doing months, whatever it is. But yes.
There's some other things that you like. I've been in companies where, cash flow was the critical issue, and I micromanaged cash flow on a daily basis. I would keep track of the ins and outs and forecast cash almost on a daily basis with companies that were struggling and in trouble. And but to do that monthly review and to have a comprehensive analysis on a monthly basis is really important.
It is. So maybe this, absolutely. So let me give you a couple other thoughts here as we sort of summarize. We're not going to, I don't think we should go into any more detail on the financials, except as it's already done. But there's other detailed things that we could get into. But the financials, they have to be at a sufficient level of detail to be able to discern problems or issues that might be going on that lead to the next level down of like subledgers and so forth. And obviously that's the intent of accurate financials and timely financials. And then these monthly or period financials, they also have to have year-to-date statements. And you got to have that. You got to be able to see the trends of month versus year-to-date. And of course, we mentioned this percentage to sales. That is so critical because depending on the industry, you're going to have standards for what you should expect in cost of goods or warehouse expenses or labor expenses or whatever. You're going to have some of those expectations that you need to have on your financials. And so there's just those industry guidelines that you want to be aware of and some that you have internally. So percentages for commissions, percentages for the cost of goods, for labor, for total overhead. And cost of goods. And there's different breakdowns. We talked about that, Brett, but you can be talking about the manufacturing process of your cost of goods, and maybe you're looking at a 14 or 17% or something like that, just for that portion of it. And all of a sudden it's 28. You have to dig into that.
Absolutely.
That's what happens. That's how you use that. So I can't overemphasize that.
We briefly mentioned it earlier, but one of the things that keeps coming up is, we want to do a holiday special. We want to do, our sales are kind of down right now. So we want to do some discounts. And so your marketing and sales efforts, I can't emphasize enough that it's important to have a plan and have expectations of what that's going to do for you. When you implement your plan, what you're expecting? Is it a plan to launch a new product or whatever? And then what it's going to cost to do this promotion, what it's going to cost for advertising, what you're going to give up in discounts, and then be able to, after the fact, take a look at what you did and analyze, do an analysis of okay, we spent, we said we were going to spend $100,000 on this marketing plan for this quarter, and we actually spent $110,000, and we thought we were going to increase our sales by 20% in this area, and maybe we increased sales 22%. That type of analysis is really important. And I've been in situations where we kind of threw a lot of stuff up against the wall, and we spent a lot of money. In one instance, I think we spent $3 million on $1 million on three different initiatives, and we ended up with 25% increase in sales, which was fantastic. The problem was we didn't know which one helped us and which one didn't.
Yeah. Stacking
you have to do that measurement.
No. But this when we get into this is actually getting into the subledgers, and one of the critical areas is promotion tracking. That's just exactly what you're talking about. And the promotion, you can do anything you want with the promotion. You can give away margin. You can give away, give away margin through commissions, through reduced sales, whatever you want, but you have to plan it out. And then you have to go back and do the analysis of it. If you don't have a promotion subledger or promotions tracking system, you need to put it together. It may not be automated, but you got to put it together manually with spreadsheets, because you have to evaluate that and look at it. And the killer issue, as you mentioned, and have been there, unfortunately, too many times, is you got multiple promotions going on at one time. We're doing a pricing promotion, and we're doing another one that impacts commissions and points and that type of thing. And then we have the results, and we're saying, okay, where do they come from? And it is a killer when you start stacking these on top of each other. You can track them, but you can't evaluate them. And the easiest thing to do is to do promotions and then move on to something else in your next promotion and never know what happened. And it's the same thing with conventions. A lot of companies use conventions, and that may be a cost of doing business, but you've got to be able to track those with a subledger and be able to evaluate those, because if they're not impacting your business long term, then you need to make some adjustments. But
trade shows can kind of be along the same lines.
Say again?
Trade shows. There's a lot of industries that I've been in where trade shows were kind of the lifeblood of the marketing efforts, and it costs money to. They always have them at Hawaii or Las Vegas or Florida, or usually in resorts. I think just to torture people because they're locked up inside working while they can see the beach outside. But those are tricky, because sometimes you have a lot of sales at the trade shows, and sometimes the sales don't come for months. You're in there collecting leads and making networking with people. And so how do you determine, the real tough question is, how do you determine if it was worth it or not? And it's kind of like an investment. You buy a stock thinking that it's going to increase in value at some point, but you're hoping for that. And then, the good thing is the stock, you can tell if it went up or down. It's often hard to determine if your effort, what you spent $100,000 on in September actually was responsible for your increase in sales in March.
Right. Of course. Yes. And on these promotions, I mean, you can have a promotion, and like you're saying, it applies to trade shows, but you can have a promotion for any purpose that you want. You want to add distributors, you want to add customers. Obviously, you're trying to lead to increased sales, and it's okay. You just have to define what those objectives are and what the potential impact on margins is. And I mean, you can go after increased sales if this is what you want to do. You can go after increased sales at a reduced margin because you want to gain that momentum or something like that. But that has to be defined and tracked. And then, I don't know, we mentioned this a couple times, but stacking of promotions will kill you because you never can evaluate anything.
And your marketing team and your executive team need to be nimble enough that they see they see the results, and then they determine, well, should we do that again? Should we
Should we do
continue
this?
down the
Should
same
we do
road,
the
or should
same
we,
disaster again, or should we
yeah,
maybe modify it or something? Yes.
no, just
Yeah.
keep doing the same thing and look for a different result, the definition of insanity.
I think I've heard that, yeah, before.
So,
Another thing, just as we sort of wrap up, Brad, another subledger that, I call it a sales subledger or whatever, but it's something that you need to have because there's other things that you need to track. And this one is an important one, depending again on the industry, but you have to be able to track. And for example, if you're doing financials on a period basis, a 4-week period or a monthly basis, these are some things that you would track and understand where you are, like you were saying about cash, but I'm talking about sales now, that you would understand maybe on a weekly basis, okay? Maybe even more often than that, depending on the industry. But you got to be able to see sales comparisons. You got to be able to see customer increases or decreases and the associated sales. You got to be able to see distributor sales and decreases, number of distributors and so forth, average sales, those types of things. Those are what I call key indicators, and they're going to come from another subledger, and maybe that subledger is going to feed the financials. But this is a different level. You can't try to put this into your financials. You put this level of detail into your financials, and you won't use your financials then. So this is something that you can look at to evaluate other things that you're seeing when you look at your financials. But this is a critical subledger that's important, and you need this at the very beginning because as soon as you start to build sales and have an impact, you're going to start asking these questions. And so this sales subledger, as I say, and it's got to be as a minimum the same cycle as the financials, but I would suggest it more often, like weekly or
well,
like cash daily, like you said, of
yeah,
course.
the good news is that there's some tools out there now. There's some resources. I think they've always had some, but there's some pretty good, affordable resources you can do that will track, whether it's, if you went to go back to the trade shows, if you went to a trade show and your main goal was to collect leads, there's some software out there, some applications that will help you with that and help you use that information later. And so,
Yes. Yeah, Brad, yeah, I'm just thinking because we haven't even touched on the software. Whether it's financial software or software for these subledgers or whatever, those are all the
yeah,
podcasts that you could do that
yeah,
just could go on forever because the software that you go through and that's the key to making these things happen. That is a big part of it. And that you've been there and done that, but that's a big part of it too. And all we're doing is touching on some of these things. I think the important aspects of financials and how financials can truly be a key part of managing your
yeah.
business.
And maybe you're tracking by region, maybe you're tracking by product, maybe you're tracking by all of it. And going back to the boring topic of chart of accounts, that's key to being able to understand what's going on with that detail. So,
I know you're right. I know we started there and somebody will still roll their eyes at a chart of accounts. You don't do that up front. You're going to get to the point. Okay. If you use this right and you use your financials, this is going to enable you to manage your business and see your growth and determine what's going on in the company. If you don't set that up, you're going to have to do that and you're going to come back around. And like I said at the very beginning, and make modifications, and it's going to be disruptive. You're going to go back and be trying to restate or recategorize your history and everything. And that is not a place that you want to be. Spend a little bit of time up front. This is what you do, but spend a little bit of time up front and define these things, and it's going to pay dividends for the business, especially as it starts to grow.
the
Especially
key
as
the key point to make with that, along with that, that's a very good point, is it's never too late to fix it.
no,
It
of
may
course
be
not.
a little more painful to go back and fix it after the fact, but I've gone into a lot of companies that have been in business for 5 to 15 years, and I've done that. We've gone in and rebuilt the chart of accounts, and there's some work involved. You've got to, if you want to have comparable data from prior years, you've got
You
to
have to,
move some
yes.
things around
Yeah.
without without damaging the integrity of the data. But if your financials aren't working for you as a tool, then it's never too late to fix it. The financial statement should tell a story, and it should tell you whether you're an accountant or CFO or CEO or a department manager. You should be able to read the financial reports, and it tells you a story on how you're doing, and maybe
Exactly.
maybe where you should go.
So, Brett, I would never suggest that a company should not go back and fix these things. I would never say that because I've been there too. But I guess what we're trying to do is to spend a little bit of time up front with doing this. And so from my perspective as a CEO, I mean, I don't know, I don't know if it's a good statement or not to make, but if the CEO can't read financial statements, there's a problem, because that is the lifeblood of what's going on in the company. And it enables you to start going on. There's all kinds of marketing issues and other types of things that have to happen in the company, but you've got to be able to evaluate where you're going and have some expectations for the future. And this is just so important. And if you don't set it up, then you got to go back and set it up, because you need this type of information in your company. Period.
And I'll add a little self-serving. The relationship with the CEO or president and the CFO or controller has to be one of trust, and one where they spend quality time together going through this stuff. And the CEO has to have a trust that the system is working properly, and that everything's accurate that they're being shown. So it's it's a team effort, and it's not just between the CEO and the finance department. It's the whole organization has to be.
Yes, it is.
Has to be working, as they say, rowing the boat in the same direction. So
right. And I mean, I wouldn't pretend that this is a favorite part of running the business, but the financials as an example. I mean, and always have the finance group involved with that. But as we'd go through and look at the international operations, I would take the GM for each international operation, and that GM with this finance person and myself and the finance person, and we would sit down and go through their international financial statement, just like we're talking about here. We would go through and go over it and dive into it, because that enabled them as a GM, and also to understand where we needed to focus and what we needed to do for the business. But we did that because if you don't do that, the tendency is just to keep doing things every day, and you're not evaluating, and all of a sudden you get to the end of the month or 2 or 3 months down the road, and you're saying, gee, we're not profitable like we should be, or whatever the case may be. And if you're not doing it regularly, what happened 6 months ago and it kept going forward, that you can't be there. And so, and I just got to add, I've worked with you a lot, and I know, and we've talked about these, and we talked about these things before we did this podcast, but and understand these principles, and that's why we've worked together for so many years. And you understand the principles and what needs to be done, and most importantly, how to execute it. And so I've always appreciated that.
Appreciate that. It was, you called me almost 2 years ago, and it was great to work with you again. And we had a lot of late night conversations of this stuff and how to set things up so that you could report back to the founders of the company.
Well, it's good to be with you and to be able to work with you again on this and to talk about these issues. So, and it may be strange that a CEO talks about these at this level, but I believe in this and think that it's critically important to the business.
Well, especially with smaller companies.
Absolutely.
Companies can't afford to have a CEO that doesn't focus down to this level. So,
yeah, and I have to say, even when we got to 350 million and beyond, we still better be focusing at this level. Okay, maybe we're doing it with the general managers of an international market or something like that, but we still better be doing it because it has to be driven down through the organization. These principles need to drive down through the organization.
It has to become a culture. Well, thank you very much for your time, Mike. I very much appreciate it.
It's a pleasure. Okay, talk to you soon. Take care.
Right, thank you.